Hello everyone, good afternoon and welcome to today's Professional Advisor Working Lunch, brought to you with Baillie Gifford. My name is Katrina Lloyd and I'm Editor-in-Chief on Professional Advisor and your host for the next hour. Before we get started with today's session, let me quickly run through the usual housekeeping. I should inform you this session is being recorded and we'll send you a link by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD and we'll be sending your proof of attendance along with the link to the recording of the session, which will arrive in your inbox tomorrow. So now let's get on with the session. After a decade dominated by low inflation, strong dollar dynamics, and US megacap concentration, global markets are shifting. Clients are asking, is US exceptionalism coming to an end, or is the opportunity set broader than ever? I'm delighted to be joined today by Stephen Hay, Portfolio Manager of Baillie Gifford's Managed Fund, to discover why they believe that a geographically balanced asset allocation could be the key to supporting your clients in today's environment. Do feel free to put your questions to Stephen using the chat function, which you'll find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, so only I can see it. I'm just going to move along so we get to our objectives and learning objectives for today. There we are. So just before I hand over to Stephen, let me quickly run through our learning objectives. So by the end of this presentation, delegates will understand why balanced asset allocation is critical today as fiscal policy, trade and currency dynamics increase US risks, how the managed fund is improving portfolio resilience through careful positioning and adaptability, and how new avenues for growth are being created by regional champions and strong company cultures. So let's hand over now to Baillie Gifford, Stephen Hay, to talk us through the presentation. Hand over to you, Stephen. Good afternoon.
Thank you very much. Thanks everyone for joining over lunch. Hope you've got some lunch with you or have had some. Anyway, I appreciate your time joining us today. Yeah, so Kat's given a little bit of an introduction, and this first slide here really kind of sums up the situation as we've known it for the last, I guess, five to even longer, 5 to 10 years now. It's been a picture of, exceptional US growth. US exceptionalism's been bandied about everywhere. And that's been both economic growth, differentials with everywhere else, and also market growth. At the same time, you've had higher interest rates, so it's been attractive from a bond investor's point of view as well. So higher interest rates, stronger economy, and a constant and a strength in the US dollar, which has been the defining feature for many years. And this has led to a concentration in the US, a concentration in indices, a concentration in bond markets, and in particular, the Mag 7 obviously has been the poster child for that, but it's been a kind of one-way story for quite some time. And the impact of this has been, there's been quite a few impacts of this. One of them, which we've certainly been aware of and noticed, is the fact that the US just completely dominates any global equity index now. So you nearly have, not far off 70% of the global equity market index is US, and that's been a big change, up 22% in the last 5 years or so, 5 to 10 years. And meanwhile, you've seen falls back in UK, Europe, shrinking significantly, Japan too. Emerging markets is the only area where you've actually seen a bit of growth in the market capitalization, which makes some sense, but it's the only one that's bucked the trend. Otherwise, it's been very much a case of US domination, US concentration, and which is something that's made a lot of us feel nervous for some time, but it's been the dominant factor and the one you've wanted to be with. Going alongside that index change, obviously a lot of money is passively managed these days and follows the index, and so you have seen flows into US assets massively outstrip flows into other regions. So it just goes along with that. But no, the UK in particular has been unloved, as we all probably know. But this has been the dominant factor. Flows into US, very significant flows into the US, and flows into emerging markets as well. And most of the flows into the US, until quite recently, have been unhedged. So people have been willing to take on the dollar risk with that because they've seen a positive benefit to having that dollar risk. And it's been such a dramatic move and such a concentration and dominance by the US that there's been definitely a sense of, can this really last? This is an extremely unusual period that we've been living through in terms of the dominance of one area and the outperformance of that area. So you can see in the chart here, the equity outperformance of the US index has just been dramatic, particularly over the last five years, but even a little bit before that. So this has been something that people have been questioning and thinking about. Well, but isn't there, from a valuation point of view, surely these other areas, must be attractive from here. There must be something on offer, and it's been these are discussions we've had. I've been in, and it's been something that just basically hasn't worked to be overweight these other markets. Just the valuations may be cheap, but they've just stayed cheap, and in some cases got even cheaper. So it's been a frustrating market for funds that have large weightings outside of the US, where there's been such a dominance from this very concentrated part of the US market, which is dwarfed returns elsewhere. And while you're still finding potentially very good companies in these other markets, it's just been the trend has been against that. And I guess what I would like to talk about today is whether we are now on the cusp of this materially changing for a significant period. And there's maybe just a few things that are beginning to add up now to say that, well, maybe now time is happening, that things are beginning to change. And first of all, within the US itself, you are getting questions over US exceptionalism. So part of the US exceptionalism has been on the economic side, and that's been led principally by significant fiscal boosts coming, tax cuts from Trump, and then fiscal boost and lots of spending on investment and tax credits from the Biden administration. And then we've carried on with Trump looking to boost the economy. So a lot of the growth exceptionalism has come from fiscal side, but it's much more constrained now what they can do in the fiscal side. So even though Trump is looking to get a big, beautiful bill through, the scale of the fiscal boost will be much less than it's been in the past. And so you're seeing definite question marks over the extent to which US growth in a GDP sense will be significantly better than other markets. And you've seen growth over the last 12 months has been a bit subdued, albeit tariffs have had some impact on that. And at the same time, you're bringing into question some of the US institutional features that have been attractive to overseas investors. So the independence of the Fed has been brought into question, and that's something which has given bond investors, currency investors, some food for thought here. What is the likely inflation outlook? How much can we use the past experience of how the Fed have behaved as a good guide to the future? And that's definitely brought some concerns about that. At the same time, you've got a worsening fiscal position because of these fiscal boosting that they've had over the last 5 to 10 years. So that they're in a much worse position fiscally. And while there's not been the same type of market bond vigilante action that has been in the French market, because the US is still a very well-funded bond market, but more concerns about on that aspect of things, and that's definitely been part of the reason for the dollar being a bit weaker. You've had continued great performance from US companies, but maybe also increasingly some concerns about whether we're in a bit of an AI bubble here as the valuations extend. So just a bunch of questions coming in about the US exceptionalism, which mean that from the US side, we seem to have less unalloyed strength coming through. And at the meantime, on the other side of things, we've seen a definite change. So the EU would be one where it's a really significant fiscal boost that you're seeing coming through in Germany. looking at 1% of GDP per annum increase in GDP growth as a result of the fiscal change, which for an economy that would typically be growing at 1%, it's a doubling of growth. That's really, really significant. And we think that'll spread out beyond Germany into other parts of the EU, principally focused on defence and infrastructure, but it will have broader economic implications. So, is the EU finally moving from a very slow growth, dull economy to something with a bit more urgency, a bit more excitement, a bit more action happening there? And in Japan too, things have changed. So we've finally exited deflation in Japan, which has been a situation you've been in for many decades. We've watched for this to happen many times in the past. It hasn't happened. It's finally happened. We seem to sustainably be out of deflation. The interest rate markets are reflecting that. So you're beginning to normalize interest rates. And because inflation is now positive and the growth angle has been pretty good, you're looking at a positive nominal growth in Japan, which is an important thing for equity markets. That's not really a position we've been in for many decades. So it really looks like something in Japan is changing too. And then on EM, I've put here intra-EM trade growth. So there's this a structural trend that has been going on, and it's actually been accelerating. So the growth of trade in between EM countries is a very strong trend. And, no doubt there's been a little bit of a catalyst given to this by US tariff action to persuade emerging market countries to look more for more stable trading relationships with their peers. So this is definitely something that's happening. The stronger dollar having faded, that's definitely helping EM. And there's been improving China sentiment too. So, on the US side, things look less exceptional, and there are some concerns. And in many other places, important markets, things are looking better. And so maybe this is the catalyst we've been waiting for. If you look at the valuations, this is, I guess, implicit in the performance chart that I showed earlier, but the US market is trading at a significant premium to all these other markets. And that's something, as I say, we've been looking at for years as being something that we think will reverse. We don't think it's sustainable in the very long run, but there's not been a catalyst for that to happen. So, from here, we have identified a number of catalysts for why these valuations may start to change. And that's why we think it's particularly interesting at the moment to look at opportunities within these other markets to where you can diversify away from the US as we look for performance catch up in these areas. So I was just going to give you a kind of a highlight of where we're looking within these areas, what's been attractive to us, and how we're trying to position the fund and take advantage of what might be a bit of a rebalancing away from the US to other markets over the next number of years. So if we look at Japan first, as I was saying, Japan, the macro situation does look significantly better from an equity market perspective, not necessarily from a bond market perspective, but from an equity market perspective. Fully exited deflation, rates are now above zero and normalizing, and we do have attractive nominal growth. So the backdrop for corporate Japan is definitely improved. And so the question mark is, well, how can you take advantage of that? So we'll just highlight one company which we like in Japan, which is Keyence. And we think it's really a beneficiary of the improved macro picture. It's a leading factory automation company, and you can think robots. And Japan is the world leader in robotics, so that would make sense. And we think with aging populations and labor shortages, when those falling robot costs will mean automation will keep on growing really fast as the companies look to replace missing workers, not just existing workers. And so Keyence is really at the forefront of that. It's leading in the development of dexterity and sensory systems, which we think can expand the application of these robotics and sensors beyond the traditional factory floor that it's been the bulk of its business up until now. And so that unlocks a really nice growth path for it. It's currently very profitable, margins above 50%. It's got zero debt, and it's got over yen 1 trillion in cash and deposits, which acts as a cushion for the company for some cyclicality, but also gives you a nice potential source of upside if the company decides to use buybacks. And that's something we've been seeing recently in Japan, been record buybacks as interest rates have gone up and there's a cash drag on the balance sheet. You've seen more buybacks coming through. So to sum up, we think it's a company with great growth prospects. We really like it. It's in a sector that we think should see growing demand, and it should be a beneficiary from the improved macro picture in Japan. Now, if I turn to another market that we think is exciting, we're looking to Europe and looking to this significant fiscal boost that I mentioned before, which really is a game changer for German and potentially European growth. The bulk of the focus of the fiscal boost is in defence and infrastructure. So I think thinking about how we could position for that, Nexans is a company that we really like. It's a French undersea cable company. It's these long-range, large voltage undersea cables, which are, really important part of the build out of the grid to incorporate renewable energy. And so Nexans' competitive advantage is really a mixture of the fact that it's this cornered resource and process power. It's one of the few companies that can manufacture these massive high-tech cables and then lay them at significant depths out at sea. So it's a difficult market to enter. So there's a large incumbency bias. Also, Nexans regularly churns out new patents, and the strength of its technology and its products is highlighted by major product wins. We saw project wins rather, which is seen recently, such as the Great Sea Interconnector project. And as its legacy contracts roll off and new inflation-protected contracts start to dominate, the margins should structurally rise. So our European team thinks Nexans is a very good growth story that's well plugged into the change in energy production and the build out of the electricity grid that we think is happening and will continue to happen. And it's really well positioned for an increase in that spending on infrastructure that should come as part of this fiscal boost coming out of Europe. Now, turning to emerging markets. Emerging markets have been, although I did mention the flows having increased and it being a slightly bigger part of the index than it used to be. We thought it, looking back 5 or 10 years, we thought it would have been even bigger by now, and it's been a bit forgotten about in recent years. And I think because there's a number of factors, but one might be just that companies have looked cheap and just stayed cheap, and people have got a bit fed up waiting for the EM performance. And I think it's also been a bit forgotten about or ignored because China's been quite challenging to invest in of late, to do with, clampdown and regulation, concerns about Taiwan, concerns about the property market. There's been a number of things to put investors off. But if we just zoom out for a minute and think that Asia's now home to half of the world's 20 fastest growing economies, it generates 2/3 of global GDP growth, and now accounts for 40% of global GDP, and that's only increasing. And there was a stat that I thought was quite interesting. So the Australian Strategic Policy Institute measures the critical technology tracker, they call it, and they look at which countries are leading in technology. And so if you look back 20 years ago, the US, not surprisingly, the US led in 60 out of 64 key technologies. But fast forward 20 years ago, China now leads in 57 out of 64 technologies, including robotics, energy, advanced materials, and biotech. So, it's basically all happening in China. And thinking about how we can, get plugged into the improving sentiment in emerging markets as the government has become less harsh on the private sector and allowed companies to grow a little bit with a little bit less or a little bit more unfettered. It's definitely improved the sentiment and the opportunities for companies in China. So one company we really like and we think is really well plugged into these trends is Meituan, which you can think of Meituan as China's leading local services super app. So it's probably best known, or it's been first known for food delivery, where it's got about 2/3 of the market share in China. It's a big market. And from the food delivery, it has expanded into in-store dining. It does travel, mobility, taxis, etc., and groceries. So the platform handles up to 70 million daily orders. So this is really a critical part of China's urban digital infrastructure. And one of my colleagues was recently in Shanghai, and they just arrived, and they had a series of meetings coming up, and they were really feeling the effects of jet lag. So they went onto Meituan and ordered a melatonin drink because they thought that would help. And Meituan delivered that drink by drone in 15 minutes, which I think just sums up some of the stuff that's happening in China is ahead of anywhere else in the world. And I think we ignore what's happening in China at our peril. And another really interesting thing about Meituan, which we think it's got a great growth within China, but it's also been expanding rapidly into other parts of emerging markets. And that's where this, just to maybe encapsulate that intra-EM structural growth. So, for example, it's in Saudi Arabia. It's called Kita there, but it's rapidly scaled up and has now got a top 3 market position in Saudi Arabia within 9 months. So there's a lot going on. Brazil, Saudi, and UAE, other markets, India. It's also been expanding quite rapidly. And maybe it's to link back to the point I made about valuations in the different markets. So Meituan is currently trading at about 18 times. That's its PE, which is below its long-term average, but it compares to the likes of DoorDash. So DoorDash is a company in the US, which is food delivery, which we really like. We hold in the portfolio, but it trades somewhere between 25 to 30 PE. And so you've got two companies that have both have great growth prospects, but there's a really significant difference in valuation here, and that's one reason why we think the opportunities in emerging markets really look attractive at the moment. But I'm not going to just talk about the other markets, because I wouldn't want you to think we are ignoring the US market. What I really wanted to get across today was that we think that there's catalysts there to change valuations and to change the opportunities within different markets, the US being less exceptional, other markets having better opportunities. But there are still some amazing companies in the US, and we still have a significant part of the portfolio invested in the US. We have exposure to what we believe to be the best 50 companies in the US. And just to highlight one of these, just to help illustrate, one of these is Duolingo. I'm sure most of you have heard of Duolingo. It delivers fun, engaging, I would say horribly addictive language learning apps, and continues to perform exceptionally well. Company's been adding users at a record pace. It now has over 10 million paying users. It's a keen user of AI. And if you have used it at all, you may well have been involved in conversations with their AI-powered tutor, Lily, who has got quite an interesting personality and voice. But effectively, because the AI is so clever and it's getting better and better all the time, she's doing a huge part of the job a normal tutor would do. I learned Spanish in my spare time, and I have a Spanish tutor that I get lessons from, and I'm rapidly finding out that the in-app tutor with AI one, it does a huge part of what I get from my in-person tutor, and it's dramatic how quickly it's coming on. But the company, it's not only languages. So one thing that's really impressed us about Duolingo is it continues to expand beyond language learning. So it's been adding courses in chess, in maths, and in music. And in my house, two of my children and my wife all use various different bits of these apps. One of my children uses chess and Spanish. And my wife uses the music and the Spanish. So they've been very successful in broadening out and increasing their addressable market. It's very playful, educational, and scalable. And the profitability has been great. It's improved meaningfully, and they've just recently achieved record margins. And so I think it's a combination of the product innovation, the brand momentum, and the company's operational discipline that, for us, continue to strengthen the long-term investment case, which we think is really, really strong. So for us in the managed fund, we are looking globally to try and find the best ideas that we can to fill into a balanced portfolio. And as we look across the portfolio, there are certain features that come out. So we think the fundamentals of our holdings are very strong. If you're familiar with Baillie Gifford portfolios at all, you'll know that what we look for is earnings growth faster than the index. And we believe that over time, and all the evidence shows that if you find the companies with the highest earnings growth, you will find the companies with the best share price performance. So that's our principal focus, trying to find the companies that will be able to grow their earnings faster than the index. So if you look at the portfolio at the moment and just look at 3-year forward earnings growth, the consensus, we have 11% versus 8% for the index. At a time when you would typically pay a premium for that higher earnings growth, and that's a premium we usually judge as we're willing to pay for the companies that we particularly favour. But the premium that we are having to pay at the moment is at the lower end of its normal range. So it's a good time to find these companies at the moment. We've been doing quite a lot of work over the last few years to improve the resilience of the portfolio. When we went back a few years, we had companies who are currently profitable was in the 70% of the fund, i.e. they were looking to become profitable, but not all were profitable. We've improved that significantly over the last couple of years and made our portfolio more resilient, which feels appropriate given the uncertainties there are geopolitically and economically. So we have over 90% of our portfolio is currently profitable. We have a pretty low debt in the portfolio, so the net debt to equity is running 19%, well below the levels you would see in the index. And the equity portfolio in the fund is well balanced by a very stable, high quality bond portfolio, which is triple B rated. And I'll come on to talk a bit more about the balance in the portfolio in a minute. But so it's looking to find companies that have that growth, but also have very strong fundamentals across the piece. So how does the portfolio look like at the moment? How are we positioned? So the managed fund typically sits with around about 75% in equities, with the remainder 20% in bonds and about 5% in cash. So the bonds are there for balance in the portfolio. They are lower volatility than the equities. So they help balance the overall volatility, and they offer a diversification from equities. So in most cases, bonds will not be perfectly correlated with equities. They'll do something different, and so that gives us diversification within the fund. And we typically hold a balance in cash of between 0 and 5%, which gives us an opportunity to buy things if the market falls significantly. So there's an option value in having some cash in the fund. I should say as well, the bonds, while they're for balance, it's a very actively managed bond portfolio as we look for the it's managed 50% in corporate bonds, 50% in sovereign bonds, and we're trying to find the best bonds that we can find, the best companies, best sovereign exposures to have to build a portfolio that can do a job of balance for the portfolio, but also give a good return. Within our equity portfolio, we split our geographic weightings into 4 regions. So again, this is a key point of difference with many other equity strategies, in particular with passive, where you will have a North American weighting of that nearly 68%. So we have a much lower weighting in North America. Now, clearly, that's been a bit challenging for the managed fund over the last few years, and we've done a fairly good job to keep up with with the index and with other funds by dint of great stock selection within our different portfolios. But it's been challenging to be so underweight the US. What I would say from here is that the balance that we're offering and that lower American weight, but still having exposure to the best American companies, could well be a very attractive thing going forward. And we think the catalysts are there for that, as I mentioned earlier. So we typically have just under 20% in the US, again, just under 20% in Europe, just under 20 in the UK, and then the same in EM and developed Asia. So that's the typical exposure we would have. We're slightly overweight our long-term average for equities, reflecting we still think opportunities are good for equities. We're optimistic on growth, and the improvements from AI is one thing, but lots of other things going on in the portfolio. So a little bit higher weighting in equities than normal, but not too much. We've been underweight the US. We'll actually just be adding to that a little bit, adding back with some enthusiasm from our US equity managers, but we're still slightly below our typical weight in the US. And overall, I think you can see from the pie chart and the weightings of each holding, we're a very diversified portfolio. It's Baillie Gifford's most diversified portfolio. It's one of our longest running portfolios, and it really is a portfolio I think is about the only one that spans a huge number of departments in Baillie Gifford. So around lots of different equity teams and across the fixed income team, it really is the best of Baillie Gifford in terms of ideas, if you like. So lots of diversification, and I'm just going to summarize now before we move on to questions. And the summary would really be that the US dominance has been extreme over the last 5 to 10 years, very unusual historically. And while there are some good reasons for why that's happened, we think some of those have faded and are changing. And at the same time, there is things happening in other regions which would argue for them to become have better returns going forward. And we have got great experience and expertise within those different regions. The likes of Japan and Europe have been running funds there for many years, in UK. And so we think this is their time, and we think they offer great opportunities, and we're able to find lots of great growth companies within those geographic areas. And so we think with all the concentration that you've seen in the US and in the Mag 7 and with AI, that it feels that a balanced asset allocation is more important today than it's ever been, and that's definitely what the managed fund would bring. So I'll stop there, Kat, and see where we go with questions.
Great, thank you so much for that, Steve, and thanks for taking us through all that and so many geographical regions as well there in the time. Just a reminder, you can put any questions for Stephen into the chat box, and I'll aim to ask those in our Q&A part of the session now. Well, maybe Stephen, I know you talked about it in the presentation, but the big question is being debated at the moment is around AI. Are we in a bubble, and what will this mean for investors? And I suppose looking at some of your holdings, you've got in NVIDIA, that's still in your top 10, although you trimmed the position in the first quarter of the year. So what's your outlook, particularly, I suppose, for NVIDIA, but maybe you can say a bit more about how the team there are looking at this AI question, because it's the big topic at the moment, isn't it?
Yeah, absolutely. I think we're still very enthusiastic about AI and how that will impact the the global economy and will help a lot of companies. So I think we're not saying that the AI is a complete bubble. Definitely not. And what's been the case is that, operationally, many of the companies involved in that would be classed as being in the AI bubble, operationally they've done extremely well. So it doesn't look like valuations are extreme based on current or expected earnings. So this is not obvious that there's a bubble in valuations within the AI sector. There's been an enormous amount of capex that's either happened or been announced and is expected to happen in the next year or two, which is, you can understand why many of these companies are wanting to invest that much. And I suppose a lot of it is, well, there's clearly some concerns with that because of the scale of it, and nobody knows exactly how they're going to monetize this. And that'll be the question going forward. We know from other booms, internet and telecoms, that a lot of the capacity will be built, but not everybody will make money from it. And so you need to pick the winners. I mean, it still feels we're reasonably early on this, so there's still mileage to go. And I suppose one of the reassuring things is that you have a lot of the big spenders on capex, on data centers and on compute capacity are funding it out of cash. They've got very strong balance sheets, and they are, although they are borrowing some from the bond market, a lot of them are funding it out of free cash flow, which makes you think that this can go on for a bit longer. So I don't want my message today on the managed fund to be taken as being that we think it's all an AI bubble and you should get out of the US completely. So it's not that. And we do have exposure to some of these names. The bigger point is definitely more about having some balance in the portfolio, having some exposure to AI, but do you want 70% of your equity exposure to be exposed to pretty much just the Mag 7? Is that appropriate for all clients? And that's where we think it probably isn't. I think on Nvidia specifically, I mean, it's been a big holding in the fund for many years, and its latest results underline the strength and the persistence of the demand, the AI demand. I mean, the company continues to post exceptional growth, revenues rising 56%, and the supply that they're able to bring is still lagging. The insatiable demand for that computing power. They did have export restrictions issued to China, which constrained sales, but the global demand has more than offset that. So we had trimmed our holding earlier in the year on some concerns about the competition in the inferencing sector in particular, but actually the combination of just that, the rising, capability of AI, the expanding infrastructure demand, and it's just Nvidia's got this unmatched ecosystem for development of chips, and that's actually strengthened our conviction in the long-term opportunities. We've actually increased our holding in AI again, and we think the risks around Chinese demand are manageable, and the more important fact is that the continued deepening of global AI deployment. So yeah, it's a semiconductor stock, so it can be volatile, but we think the outlook is still pretty good for Nvidia.
Yeah, because there was obviously that shock early in the year. It seems a long time ago now after all that's happened, but with DeepSeek coming in and looking at other disruptors that could be in that part of the market, I think that was what people were worried about at the time, weren't they? And how was your thinking around that? We're a few months on from that, but how did that play into your thinking?
Yeah, it was a bit of a shock to the markets when DeepSeek came out with the ability to do certain things much cheaper and cheaper. I mean, it certainly was pause for thought, and it probably did concentrate minds a bit on thinking about how do we try and improve efficiency. Still some doubts, I think, about the exact objectivity or veracity of the claims from DeepSeek, but I think it's just, I think since then people have probably regained some confidence that the developments are all coming thick and fast out of many of the biggest US companies, that they're still leading massively. But yeah, I think that'll be a continual theme that we will see, maybe the US ahead and then China will catch up, and there's so much positive going on in China from an AI development point of view and just broader technology that we really can't discount what's going to happen there.
I've got a question here. It picks up on something you were referring to about passive investing within the presentation, but how has the massive shift to index-based investing changed your mindset to how the markets might behave in the future?
Yeah, well, I think it makes the markets more vulnerable, because there's obviously less knowledge of the individual companies, and I think we could see flows move very significantly, and the markets be more volatile. For us as active managers, it can clearly be challenging when things become so concentrated into one area, and that I think is probably damaging in the long run. But then when things change and we see underperformance, then that's where you want to have active stock picking and be able to move away from things that are just getting increasingly overvalued. So it's challenging. It has got some challenging features. I don't think it's a good thing for equity market bred stability, resilience, but it's a fact of life. So we have to live with it.
Yeah, and that leads us on to talk a little bit about, you mentioned it again in the presentation, but about building resilience in the portfolio. Maybe you can say a little bit about what you've done over the past couple of years. I mean, 2022 is still in people's minds. It was an extremely tough period. And what have you kind of learned from that, and how have you been sort of really trying to build the resilience in the portfolio since then?
Yeah, I mean, we would certainly see 22 alongside 2021. 2021 saw very, very good performance of the strategy, and then that reversed significantly in 2022. So the largely went as a wash over the 2 years, but clearly people who invested in 22 didn't see it that way. But I think it's just a very, very unusual period. So it's not something that we're wanting to, necessarily dramatically react to. We're clearly looking at a slightly different environment with a bit more inflation, interest rates higher, and so the adjustment to that has been is a headwind for a growth equity fund. So that's been challenging. We're through that. We've passed through that. Rates have moved up, but in most cases are beginning to move down. Inflation's back under control, and I think we'll continue to keep falling. I'm quite a bull on falling inflation. So it's been taking over that period. We have looked at every company in the portfolio and looked at its resilience and retested the investment case. And part of that's about the amount of debt the company has. So is it resilient to higher interest rates, or is that something that's going to be a headwind for growth going forward? And just making sure we're being honest with ourselves about the opportunity for these companies and the route to profitability. So I guess it's been a little bit of a tightening up of just making sure that the investment cases remain solid, that we think companies can achieve the what we expect them to have, and just having milestones in place that make sure we're honest with ourselves, and if they're not working, we should move on, and there's plenty of competition for capital in the strategy.
Yeah, I was going to talk as well about, you mentioned obviously the balance within the portfolio, and you're weighting to the UK, which, as we know, UK weightings have been falling across a lot of portfolios, but you still have that sort of weighting in there. And maybe you can tell us a bit about that UK weighting and how it's invested.
Yeah, I mean, if you go back in history, we launched this strategy in 1987, and it was for UK investors, and it had a very high UK weighting at that point. And over the years, that became less and less appropriate, and so we decided to bring that weighting down. I mean, as you know, the UK has a very, very global stock market. So as we look at the UK market, most of the companies have exposure to what's going on globally, and it's not the UK economy that we are being exposed to within that sector. I mean, the way it works is that we, if we felt the there were more opportunities out with the UK, then we would just bring down the UK weighting. So that's, as I said, we our kind of strategic weight, if you like, is just about 18% in the UK. But if we felt that we were seeing better opportunities elsewhere, whether it be Europe, EM, or the US, we would reduce that weight. And if that weight stayed lower, we would probably bring down our strategic weight over time, just to follow the enthusiasm and views of the managers. But that's not actually been the case. So we have continued to find lots of good companies in the UK, and they've actually done pretty well in the portfolio. It's been a reasonably good place to be. And from here, we think UK can do better. There's been a lot of not unfair, but there's been negative sentiment towards the UK for a number of years, which we think is beginning to fade. I think the UK economy can actually do a little bit better from here.
Yeah, maybe you could say a little bit more as well. You mentioned it in the presentation, but just about how this fund sits with other Baillie Gifford funds within the range, what the overlap might be with other funds, how investors might expect it to perform, a little bit about how the team structure works that's running the portfolio. Yeah.
Yeah. So I mean, as I said, it's the broadest fund in Baillie Gifford. So you'll find, in pretty much any stock that's a Baillie Gifford favourite in other strategies will be in this strategy. It would probably the case. We will have a more diversified version of some of other funds. So people who will be familiar with, for example, our Global Alpha portfolio, or with Monk's Investment Trust or Scottish Mortgage Investment Trust. These are much more concentrated, especially Scottish Mortgage, much more concentrated. They can obviously hold private companies as well, which we don't within the managed fund. It's all listed public equity. But there'll be quite a lot of commonality of holdings. It's a silo based fund. Whereas a lot of our other funds are holistic within Baillie Gifford, but it is silo based, and that's worked well for us over the years. So we have our UK equity team managing our UK portfolio, European team managing the European portfolio, an emerging market team managing the emerging market, a developed Asia and Japan, and then a US team managed by our US team. So again, the holdings in there, for those that know the American fund, the holdings will be very similar in our US portfolio. So really accessing the best ideas from all the teams. And then in the fixed income side, we have our corporate bond team and our sovereign bond team coming together and choosing the best bond portfolio. So that's where all the individual ideas come from. From an asset allocation point of view, we have a small committee that gets together regularly. Myself and Ian McCombie are the lead managers. I'm actually from a fixed income background. Ian looks after the UK equity portfolio, but has got many years of experience. So we've been doing this for about 13 years on the managed fund, more experience than that, but 13 years within the managed fund, and we will lead that decision on asset allocation. And what we're trying to do, we are, for people that know Baillie Gifford, we're not really an investment manager that has a very strong macro view. We don't put out macro reports to say that UK interest rates will be cut or the dollar is going to weaken. It's much more, we definitely lead on the stock selection and work and trying to find companies that can do well in lots of different environments. But we do discuss the different potential macro and geopolitical events that will happen and how the portfolio is positioned. But what we're not making top-down decisions on and overweighting a different. We don't say we like European equities versus the UK. We don't do a top-down macro-based asset allocation. It's actually based on the underlying enthusiasms of the different equity managers. So we all get together and we'll discuss and hear from our European equity manager, Stephen Pace. We'll see how enthusiastic is he about his holdings. Does he want more cash from to come to his area for him to invest in what he thinks are great opportunities? And that'll be debated between him and other regional managers who will say, well, yeah, you might want more money, but there's some great opportunities within EM at the moment. Let's talk about those and let's compare. And it's because we've all been working together for a long time. It's a very collaborative approach, and we were looking to really flush out where the enthusiasms are for different stocks in different regions, and then that's the main reason for causing flows between the different sectors, and that's the driver of asset allocation as opposed to a big top-down view.
Great. So maybe then just finally, you could just maybe talk us through a few recent changes you've made to the fund and sort of the thinking behind those.
Yeah, well, I was going to mention Cloudflare, which has been in the fund for a little while, but Cloudflare is one of our top holdings. It's one that maybe isn't quite as familiar to people as some of the other tech or AI names. But when we think about the impact of AI, we think about the kind of the enablers of AI, and NVIDIA would be a classic example, the kind of nuts and bolts, or the picks and shovels, as they say, of the AI. And then you've got the app. The applications that are built on AI. And I think Cloudflare is in the enablers camp, and so it's one that really looks to try and maintain internet security. So I think about a fifth of the internet globally is defended by Cloudflare, and it's really cybersecurity in the cloud is basically what it does. And you'll with all the recent developments with cyber attacks on M&S and Jaguar Land Rover, etc. We see this as a really crucial area going forward, and Cloudflare is a very exciting way to play that, and it's one of our most exciting holdings, I think.
Great. Well, I'm conscious of time, but thank you so much, Stephen, for joining us today and taking us through those areas. A lot to cover there in the time, but I'm sure if you do have any further questions, then Stephen, the Baillie Gifford team can help you answer those. Just before we close, I'm going to go through the learning objectives again, so they should be on the screen for you. So by the end of this presentation, delegates will understand why balanced asset allocation is critical today, as fiscal policy, trade and currency dynamics increases US risks, how the managed fund is improving portfolio resilience through careful positioning and adaptability, how new avenues for growth are being created by regional champions and strong company cultures. And as I said earlier, your CPD points will be delivered tomorrow along with the recording of the session. But just before we close, I just wanted to leave you with some more information about some upcoming professional advisor events as we race towards the end of the year. So later this month, our retirement planning roadshow will be visiting Harrogate, Warrington, Coventry, Bristol and London on the 18th, 19th, 20th, 26th and 27th of November. And delegates will hear from Just, L&G, Premier Miton, Quilter Cheviot and Standard Life, along with a keynote presentation from Aberdeen Advisors pensions guru Andy Zanelli. And obviously a key time at the moment as we're preparing for the budget, so it'll be really interesting to hear their views. On the 4th of December, we have another of our digital working lunches. This time we'll be joined by Baillie Gifford's Rosie Rankin, and she's going to be discussing their positive change strategy. And finally, we're closing the year with our last working lunch of 2025. We'll be joined by Schroders to present the results of their ever popular advisor survey. So that's a total of 8 hours of CPD over the next couple of months. And as ever, if you wish to find information or sign up to any of the events, you can do so by visiting www.professionaladvisor.com/events. So that's it for today's session. All that remains is for me to thank Stephen once again for the presentation and for answering our questions. And thank you once again for joining us at this lunchtime. Hope you found the session helpful and worthwhile. And we really hope to see you at another Professional Advisor event very soon.